1MDB. One of the biggest financial scandals in Asia began in 2009 and is still being unraveled. The story of One Malaysia Development Berhad, 1MDB, involves Malaysia's Prime Minister at the time, Goldman Sachs, and a blockbuster movie starring Leonardo DiCaprio. Jho Low, a young financier who masterminded the fraud, is now an international fugitive. In 2009, Malaysia's Prime Minister Najib Razak launched 1MDB as a strategic development company, which was owned by the Malaysian government. Amongst the fund's objectives were ESG investing and funding projects to drive growth for Malaysia's economy. The fund then went about setting up companies and joint ventures with specific objectives. Amongst the investments was the company that produced the hit movie Wolf of Wall Street. In 2012 and 2013, Goldman Sachs helped 1MDB raise $6.5 billion by selling bonds. However, within 2 years the company missed a loan payment, and it emerged that $700 million belonging to the company had found its way into Razak's bank account. In the wake of the unfolding scandal, Razak's party lost power for the first time in decades, and he and his wife attempted to flee the country. It has since emerged that as much as $4.5 billion were embezzled by key officials. The perpetrators covered their tracks by transferring money back and forth between a complex web of shell companies. Investigations are still ongoing, but it is clear that billions have disappeared and were used to buy jewelry and a super yacht, and to fund the lavish lifestyle of Jho Low. The key players in the saga have all claimed they are innocent and continue to blame one another. However, Goldman Sachs agreed to a $3.9 billion settlement with the Malaysian government for its role in the fraud. WorldCom. During the 1990s, WorldCom was the second largest telecommunications company in the US. However, in 2002 the company collapsed after wide-ranging accounting fraud was uncovered. Telecom companies performed very well during the 1990s as the use of mobile phones grew. When the industry later came under pressure, WorldCom executives turned to cooking the books. They inflated revenue and listed expenses as investments to create the impression that the company was still profitable and growing. Investors believed the stock was still a good investment, and so at its peak the company was valued at $180 billion. At the time, this meant it was one of the most valuable companies in the world. When auditors discovered that revenues and profits had been overstated by as much as $7 billion, the stock price quickly collapsed from $60 to $1, and thousands of employees lost their jobs. The company filed for bankruptcy protection and later emerged as MCI, a much smaller restructured company. MCI was later bought by Verizon Communications. In 2006, WorldCom's CEO, Bernhard Ebbers, was sentenced to 25 years in prison. He was released earlier this year after serving 15 years and died shortly thereafter. The WorldCom scandal remains one of the world's largest corporate scandals and resulted in nearly $180 billion in losses for investors and thousands of lost jobs. Bernie Madoff. In 2008, Bernie Madoff's hedge fund empire was exposed to be another Wall Street fraud and the largest Ponzi scheme in history. This story is also unique in that it wasn't ordinary people but wealthy investors and fund managers that were fooled and suffered losses. Madoff posted impressive, but fictitious returns for his hedge funds. Supposedly he was investing in blue-chip shares, and then engaging in portfolio hedging by buying options on the S&P 500. The fact that his funds appeared to generate steady returns with low volatility meant he had a steady flow of new capital flowing into them. Very few investors ever withdraw their money, so he was able to maintain the illusion for a very long time. Eventually, in the wake of the 2008 global financial crisis, it became clear that the charade was about to collapse. Madoff's own sons reported him to the SEC. In total, investors lost $64 billion, though the money never really existed in the first place. Madoff was ultimately sentenced to 150 years in prison. Madoff started out with a legitimate business, and it's not quite clear when it actually became a Ponzi scheme. Some believe the fraud began in the 1980s, which would mean he kept the scheme going for as much as 20 years. Red flags were also raised by investment advisors and traders long before the fund collapsed, but the SEC ignored their warnings. It also appears that some investors knew the returns were too good to be true but allowed greed to cloud their judgment. 2008 Global Financial Crisis. The GFC of 2008 is typically regarded as an economic crisis and not counted amongst financial scandals. However, amongst the many causes of the crisis is a long list of unethical behavior, conflicts of interest, and corporate fraud. For a start, rating agencies were paid by issuers to give very risky securities investment-grade credit ratings. This presented a conflict of interest as rating agencies had a financial incentive to overlook the true risk a security carried. Next, mortgage originators encouraged home buyers to exaggerate their assets and income to ensure mortgage applications were approved. They also used aggressive sales tactics to sell mortgages. Later, banks were found to be illegally foreclosing on properties. Banks sold securities to investors that they knew to be incredibly risky. In some cases, banks were short-selling the same securities they were promoting to fund managers. Banks also created synthetic products to help hedge funds bet against the mortgage market. One of the big catalysts for the crisis was Lehman Brothers, which filed for bankruptcy when it could not be bailed out. One of the factors that contributed to the demise of the bank was a very dubious method of valuing repurchase agreements on its balance sheet. A loophole in the accounting standard allowed them to use repurchase agreements to hide the true extent of their leverage and debt. Wirecard. The recently uncovered fraud at Wirecard has turned out to be one of Europe's biggest financial scandals. Wirecard, which was a member of Germany's leading stock index and one of the biggest fintech success stories in the world, collapsed in June this year. The fraud at Wirecard was actually remarkably simple. Wirecard was a company that processed payments on behalf of merchants. In certain countries, Wirecard used subsidiary companies to process these payments on its behalf. At some point, the company began reporting fictitious revenue from these subsidiaries, which eventually accounted for the bulk of Wirecard's profits. When analysts, investors, and journalists questioned the lack of cash flow from the subsidiaries, Wirecard stated that the cash was all held in the subsidiary escrow accounts. This would mean that cash was in the same account that payments were processed through, and therefore difficult to dispute. When the media and several whistleblowers alleged the revenue did not exist, Wirecard accused them of trying to manipulate the share price for short sellers. They even sued the Financial Times, which resulted in German regulators investigating the journalists rather than the company. This is an increasingly familiar pattern when financial scandals involve listed companies. Company management will often accuse short sellers and hedge funds of trying to manipulate the share price. In many cases, regulators end up siding with the company, fearing the effects financial scandals might have on investor confidence. Eventually, KPMG was asked to investigate and confirmed there was a hole in the balance sheet. It ultimately transpired that around $2 billion in liquid assets simply didn't exist. Within days, the share price collapsed from €100 to zero. Wirecard, which was worth $28 billion at one point, is now insolvent. This makes it one of Germany's and Europe's biggest financial fraud cases.